Alright guys, welcome to Module 1. Let's go ahead and get started. Now, as I mentioned, we need to get our basics down first. So we need to learn how to crawl before we can walk and then eventually run. So the first thing that we're going to talk about is market structure. Now, market structure was the first thing I learned when I started trading in forex, and it was also subsequently the first thing that I forgot. So I would be remiss if we didn't start here and build our foundation off of one of the most important parts of forex trading. So, quick recap. In this module, we are going to go over using support and resistance by talking about market structure. Next video, we're going to talk about major levels, points of reaction, points of failure, because these levels of support and resistance are going to tell us where price is going to react in the future. And we're going to talk about quarter points in video 3, psychological levels of support and resistance, whole numbers, things of that nature. And then our last video, we're going to talk about the differences between price getting rejected, price breaking out of a level, and then our classic retest, which is going to be our bread and butter entry, is that the retest of either a rejection or a breakout at a specific level. We're going to talk about our 3 types of entries, and I'm going to keep repeating these until you're tired of hearing of it, but our 3 entries are aggressive, are conservative, and are confirmed. Okay, so you're going to hear me talk about those throughout the entire rest of the course. Best that you commit it to memory now. So, first thing we need to do is we need to determine the trend. That is just step 1 of trading. We need to know, are we trading with the trend or are we trading against it? Now, that doesn't mean that we can't trade against the trend. I mean, you've heard, everybody that's been in forex for any length of time has heard the adage that the trend is your friend, and that is a very true maxim, that you're going to get your most profitable trades out of trading with the trend because the movement is going to be greater. You're going to be able to take more money off the table with a trending trade, but that doesn't mean that we won't have our opportunities to take our counter trend trades. It just means that we need to know, are we taking a trending trade or are we taking a counter trend trade? We need to identify that right off the bat. Okay, it's going to be crucial because that's going to play into our risk management, because counter trend trades are going to be much higher risk. And because of that, we're going to need to adjust our lot sizes accordingly, and we're going to need to adjust our risk management accordingly. So first thing we need to do is identify what is the trend and are we trading with it. Now, market structure is very, very basic. Okay, there's no need to overcomplicate it. Market structure consists of 4 things. And you've heard it before, hear it again. We have higher highs and higher lows, lower highs and lower lows. It's just as simple as that. Okay? We can break it down to a much lower level and really get into the minutia of market structure, but at its very core, we're only looking at those 4 things. We're looking at higher highs and lower highs in an uptrend, and we're looking at higher lows and lower lows in a downtrend. Okay? Another thing that we're going to want to keep in mind is that the higher the time frame, the stronger the trend. Now, what do I mean by that? I mean that if you look at a 15-minute time frame and you see an uptrend that's been happening, let's say over the past couple hours, that trend is going to be relatively weak compared to zooming out to the daily time frame and seeing what has price been doing over the past month, 3 months, 6 months, or even the last year. So we need to start at a much higher time frame to get a better idea of what the overall trend is. What's the higher time frame trend? Let's look at a daily and an H4 chart and determine, are we in an uptrend or a downtrend? Then as we do our top-down analysis and we drop down into the 1 hour and the 15-minute time frame, we can see, are these lower time frame trends in line with the larger trend, or are we currently in a lower time frame counter trend? And I'm going to tell you right now that some of the best trades that you can possibly take are when the smaller time frame trend matches the higher time frame trend. Okay, write that down. Make sure that you remember that. Have that be rule number 1 in your book. that the most profitable trades that you're going to take, the highest probability of paying out, are when your trends are in line with each other. Like if you're in an uptrend in the daily and you drop down to the 4-hour and you see that price is also in an uptrend on the 4-hour, and then you drop down to the 1-hour and you're seeing price also in an uptrend on the 1-hour, that is a very high probability trade, and you definitely want to look for an entry to go long in that market. You're going to have much better success rate if you're trading with multiple time frame trends that are in line with each other. Let's take a look at a chart. Well, let's not even take a look at a chart yet. Let's just take a basic look at what I mean by market structure. So if we're talking about an uptrend, we're talking about price making that a higher high and a higher low, another higher high and another higher low. Okay, and these points have to be higher than the previous high or the previous low. So here we have our higher high, and then here we have our higher low. Okay, and this point is higher than the previous low, or else it would be obviously a lower low. So this next low is higher than this previous low, and so on and so forth. Same with the highs. This higher high has to be higher than the previous. This higher high has to be higher than the previous. And that's how we get our basic market structure. I know it sounds very simple, but so many people forget just this most basic tenet of market structure. If we're looking at a downtrend, we have lower lows and lower highs. Lower low, lower high, and so forth. Okay, so when we look at an actual chart, we can see that we're either making higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Now if we're making neither, then we're in a ranging or a consolidating sideways market, and we have no trend. And we'll get into how we trade those types of sideways channels, how we look for breakouts, but for right now we just want to focus on the most basic aspect of market structure. Now if we look here at this very basic daily chart on pound sterling Swiss franc, we see that we have that very exact same setup. We have higher high and higher low. Higher high, okay, it's higher than this previous high. It has to be, or else we don't have that market structure. Higher low, higher than this previous low. And we could keep going on. And you can mark it up like this, or you can just mark it up like this. Your preference, how you want to see the market moving. Are you looking for larger impulse moves as far as impulse legs, or are you wanting to count these smaller retracements? As long as this next peak that you're going to is higher than the previous, it counts. Okay, you're still going to be in an uptrend. And then as we start our downtrend, we have a lower low followed by a lower high. This high is lower than this. This is our new lower low because it's lower than this one. Okay, lower low here, just barely, but still it closes below that low. As you can see with my crosshair tool, we're looking at the close of the candle, and it's relevant based on the time frame that you're looking at. Right now we're looking at the daily, so I'm only looking at candle closes on the daily. Again, this is part of our top-down analysis. Okay, and then we see price switch direction and change trend, and we'll talk about that in just a second. Okay, so let's take a look. Now, how do we know if a trend has changed? Very simple. In an uptrend, price must break the previous higher low and create a new lower low. And in a downtrend, price must break the previous lower high and create a new higher high. All right? let's look at that also on a chart. So if we look at it here, in an uptrend, we have our higher high and our most recent higher low, and then we have our peak. And let's say that price reverses at this point. First thing we need to identify is our market structure of support and resistance. Our higher high, or our previous higher high, is here. Now this is usually where we get our Fibonacci retracements at, and we'll go into that in the Fibonacci and the Elliott wave module. But for now, just make a mental note that we need to make note, mental little note, put a pin in this, that we need to take note of that most recent higher high prior to this new higher high. Then we have our most recent higher low. Okay, so where does our new trend begin? The new trend begins once we break this most recent higher low level. Now we need to see price break through this and retest it. Once it's retested, it's become valid. Now we're in a new downtrend, because we've broken this level of structure. And this is just the most basic way using market structure that we can determine if we've started a new trend or if we're just in a consolidation period, possibly a ranging period that's looking to break out. Because again, a lot of times if we get pulled back to this level, to this higher, most recent higher high, this is usually more of a Fibonacci retracement that's going to continue that uptrend. That would be just a new lower high, or a higher low, a new higher low. Okay, if we get a pullback to this level, it's still not a downtrend because it hasn't broken this higher low. This could easily bounce back up, and this is what we call a deep retracement. This first type of a retracement is a normal retracement. That's where we're looking at our 61.8 and our 78.6 type of Fibonacci extensions and continuations. Okay, this second example is a deep retracement, 100% retracement all the way back down, but it is still a valid retracement for a continuation because it has not broken this level. And this is where we'll get some of our chart patterns out of, and I'll show you that a little bit later in this video. Once we get this break though, and this retest, this new lower low, that's when we know we've started a new trend. And that, now we will have our outliers. It's not 100% of the time, but I'm going to say 95% of the time that this structure validly depicts either a continuation of a trend or the reversal of a trend. Okay, let's take a look at this chart again. Now if we look here, all right, we had our higher low and our higher high, and then we had a little bit of a double top formation here, you know, depending on how you want to break down the retracements of this chart, the price movement. Okay, then we had price come all the way back down. Now again, this is what I'm referring to as far as our deep retracement. You see how price never broke that level? Not yet. Okay, it's still not a new trend, even pulled up a little bit. Here, when we had this break, this is when we knew that we were possibly in a new trend. Okay, now we had price come back up and retest and drop. Now we have a new lower low here, followed by another lower low here. Now we did get price that pulled back. Again, this is one of our outliers because it's not going to be right on the dot every time. It's not going to hit these levels exactly every time. Price never does. But we had a little bit of what we'll talk about in later modules as a false breakout. But as you can see, we eventually did keep on dropping down and form that new downtrend. Okay, so if we take a look in an uptrend, we start with higher highs and higher lows. Higher highs, higher lows, higher highs. That gives us our most basic market uptrend. Now in a downtrend, we have the opposite. We have lower lows and lower highs. Lower lows, lower highs, so on and so forth. Downtrend. Very simple. But this is one of the main things that it seems most traders are first to discard out of their toolbox because it seems so simple, it doesn't seem like it's relevant or useful when you're actually trading. Okay, I'm going to tell you that is absolutely not true. You need to remember this structure at all times. You'll be going back to this most basic highs and lows market structure format for the beginning of almost all of your trade analysis. All right, so let's take a look at a trend reversal. So as we mentioned, for a trend to reverse in a downtrend, as we see here, we need the most recent lower high to be broken for us to validate that the trend has reversed. Now it can either be broken and we can have a new higher low form, or it can pull all the way back and retest that level and validate that in a downtrend that resistance has now become support. Both are valid indications that we have trend reversal. The main point is that lower high, the previous before the last valley or peak in an uptrend, has been broken. Let me show you what I mean. So we have, and we've made a new lower high, and this is our most recent lower high. Price continues down and forms our lowest point. Now price is reversing, but we don't know for sure if it's an actual reversal yet. As we can see, this is the level of our most recent lower high. Price comes up to that level but gets rejected. So we have what we had referred to a little bit earlier as a deep retracement. Price is retraced all the way back to the 100 level, but that level has held and rejected price. So we don't have a complete trend reversal yet. Price drops and now pushes all the way through that resistance level, turning it into support. And in this example, we don't get a retest, but we do get a pullback. Price does form a distinct swing low, which makes a new lower high, that's a new higher low. And we have verification that we are now in an uptrend. Okay, let me change that really quick. New higher low. Okay, so now that we have that validation, and you can see that this is forming our most popular chart pattern, the inverse head and shoulders pattern. Okay, so this might be a little bit of an aha moment for you, but the right shoulder of a head and shoulders pattern is just a pullback. It's the very first pullback of a possible trend reversal that didn't break the neckline. This blue line representing our neckline, that doesn't get broken, and that's why when it does get broken, that's why we wait until that point until we enter a trade, because now we're confirmed that the trend is reversing and we definitely want to get in on that new trend. Okay, so structure gives us the basis for our most popular trading patterns, right? Structure, like I mentioned in the past, is one of the reasons that we use Fibonacci retracements as our levels to look for price to reverse at. As you know, as we saw in that previous example, the structure of the previous higher high or lower low forms the levels that we look for those 50 and 61.8% retracements to get rejected off of. And that's why our Fibonacci levels work so well. And that's why lesson 2, I believe it is, we will go in great detail on Fibonacci levels and how we can use those to our advantage to enter trades with very, very high accuracy, taking very little drawdown. Now, market structure is also what gives us our double tops, or our M's. And the new trend is basically made when we see the neckline break and get retested. As we saw in that earlier example, we had a head and shoulders pattern, an inverse head and shoulders. But when we get our double tops, the same type of market structure applies. So we're just looking for that validation that the trend has been changed, and instead of trying to catch that trend at the very top where the M or the W forms, we're taking much safer trade by taking it after the break of the neckline and then the retest of that neckline. And that's where we see some of our most profitable trades, like our 2618 trade, and we'll go over that in the Fibonacci lesson and the Fibonacci modules. And as I mentioned, now this might be a kind of an aha moment for you, but a head and shoulders pattern is the right shoulder is just an unbroken neckline. That's all it is. It's 100%, not 100% retrace, but it's a retracement down to that level of basically where the lowest point of the left shoulder was, and price getting rejected off of that. And then we see a small pullback, which we can measure with our Fibonacci. And then once it finally drops down and breaks that neckline, then we can enter into a trade. And then almost all of our other chart patterns are made off of this very simple market structure. And let's take one last look at that. Okay, so again, we have our market structure. We have price coming up, down. Now we have a higher high. Okay, now we don't take trades until we see breaks of these structure levels. Again, we have our normal retracement to this support level made by the most recent higher high, and this is where we'll get a lot of our ABCD patterns taken off of. We'll see our 61.8% retracements here, and we'll see our one-to-one moves of a trend continuation if we see a rejection at this level. If we see price come all the way down here to what we call a deep retracement, now we're looking for either price to break through and form that new trend, or this is where we get our rejection, and this is what I'm talking about as far as now we look to see that right shoulder get formed at this level. Okay, we also have our rejection at this level forming our double tops. Okay, and in both cases we're looking for price to come down to this neckline. That's why I say that the right shoulder is just the first rejection at this neckline with a minor retracement back up, and now we're waiting to see it drop all the way back down. And once it comes through this level, breaking this most recent higher low, obviously it's the reverse for a downtrend. Now we're looking to see price come back up and form either a swing low in this area or retest this level, either one validating that that support is now resistance and we are in a new trend. Okay, now most of our chart patterns are going to come from, like I said, this market movement. We see our higher high, higher low, higher high. Now if we don't get a break of either this level excuse me, I'm using the wrong tool. If we don't get a break of either one of these levels, here or here, that's what forms our patterns that we'll look at in a later module, but that will be part of lesson 1. And we're talking about our ranging consolidation. Okay, we have our channels here where we have price just bouncing back and forth between these two levels. Okay, then we also have price coming up here. Let's say we're using the same example, and then making smaller and smaller retracements. Never breaking this low point, which is symbolized by this line here. And that gives us our pennants and our wedges and all of our consolidating market patterns. So all of these are built off of market structure. So if we know that this level hasn't been broken, then we know what to look for. As far we want to look for our wedges, our pennants, our flags, our head and shoulders, our double tops, things like that. But the moment that this gets broken, now we know we're not looking for chart patterns anymore. Now we're looking for breakouts, retests, and pullbacks. Okay? Now I hope that makes sense. I'm trying to keep these as under 30 minutes as possible, but market structure is so very, very important, and it leads us into all the other aspects of our trading that I wanted to make sure that we really went over it as thoroughly as possible, and this barely even scratches the surface. I could do an entire 2-hour webinar just on market structure, and probably one of our very first student webinars that we'll have next weekend. I'm going to go over market structure in even more detail, and then that'll be recorded, and I'll add that to our curriculum. So any new students that joined after the fact will have access to that video. Okay, so it's time for homework. This is your guys' homework. Please complete this before moving on to the next video. I want you to watch this video at least 5 times. Okay, catch all the little things that you might have missed the first couple times, because it was a lot of information that I put your way, and nothing that I mentioned in this video is superfluous. Everything that I mentioned is very, very important. I really tried to keep just the meat and potatoes in this video. Now I want you to mark up 5 charts showing me market structure in an uptrend, just like I did in my earlier example, and 5 charts showing the market in a downtrend. I want you to mark with an arrow, a line arrow, market movement, price movement, and where it reaches higher highs and higher lows. And I want you to show me those on the chart. Label them. And then I want you to do 5 charts showing market structure reversals. So show me those double tops, those double bottoms, and show me where the market broke that structure. So you're going to be doing 15 charts total, and then send those to me in the Telegram channel so that I can take a review of them, or that I can review them, and I'll give you a thumbs up. When I give you the thumbs up, then you're clear to move on to the next video. So let me show you just real quick on a chart. I want you to go in and just take a chart, any time frame. Take the drawing tool and do exactly like this. Show me your higher highs, higher lows, show me your lower highs and your lower lows, and then label each one. Okay? That's a higher low. This would be a higher high. Sorry. So this would be our higher high if this is where you're starting at, and this would be your lower high, and so on and so forth. And this would be your lower low, lower low, lower low, until you get a reversal. And then I want you to show me 5 charts where the trend has reversed, and I want you to show me the 2 points of structure. I want you to show me the most recent lower low and the most recent lower high, and which one, once broken, shows us that we are in a new trend. Show me if it was like here, if we had a just a new swing low form, a new higher low, or if we actually had a retest of these structure levels and then continued on. All right, so that's your homework. This was Module 1. Thanks for joining me for our market structure video. Our next lesson, we're going to go over institutional levels of support and resistance. We're going to look at our points of resistance, our points of failure, and this is going to show us how we can trade in line with the banks, because these major levels are made not by retail traders, they're made by institutions. So when we see banks set these levels, we want to take note of that, because we want to be trading with where the smart money, the big money is. We don't want to trade with the dumb money, with the other retail traders, the 90% that are giving their money away to the market. All right, guys. Again, thanks for joining me. I've been Ryan with ZenFX. I'll see you guys in video 2.